Your views, obviously, you know, we always say that ecologically Africa is not prone to some of these things like tsunamis and earthquakes, but we also have our own disasters, for instance, flooding and drought. Are we prepared to deal with them?
I'd say from the social dynamic, probably less so. In the more formalized parts of the economy, more so. And I think that's one of the challenges around Africa, is that we have quite a large dispersion across the formalized and corporate side of the economies versus the greater part of the community, which doesn't always have access to the more formalized or sophisticated, mature corporate models. So the answer is always a yes or no. And unfortunately, when large disasters of, let's say, a weather nature strike, they affect the community a lot more than perhaps the formalized economy.
I mean, obviously, people looking at the markets in Asia have been focusing particularly on the insurers and the reinsurers, because that's really where we're going to see a lot of demand for reconstructive activities. It's a vibrant market nonetheless. What about in Africa?
In Africa, the market, the insured market is a fraction of that one sees in highly mature markets like Japan and Europe. There's the majority of assets in Africa are not insured. And then if you look at the assets that are developed, a lot of those assets are developed through local authorities, municipalities. Again, speaking for South Africa in general, the local authorities don't buy insurance to a large degree. They have reserve funds and replenishment funds, but those are needed for developmental projects and so forth. And it's a tragedy that those funds have to be used against the freaks of nature. So again, to the extent of insurance capacity being available, it's more towards the corporate market and much less towards the social community and those assets and infrastructure projects that are used for the community at large.
I mean, obviously in Africa we do have our freaks of nature, such as droughts have said, but we also have other phenomenon, and risk is quantified in very different terms here. Now with global security issues, there's the risk of terrorism, there's the political risk factor, there's the risk of piracy in East Africa, the risk of key assets like energy assets being sabotaged in a country like Nigeria because of the situation in the Niger Delta. How do you go about calibrating some of those risks?
If we knew the answer, you know, we'd all be rich. One needs to look at the circumstances, and risk is purely a function of impact and likelihood. And the issue with Africa, and I think if I generalize unfairly, I apologize, but the likelihood in Africa is one where one can't always rely on the legal or social norms to protect oneself against risk. And to, you know, so for a strongly functioning either security forces or otherwise to hold up the norm as one would expect. The next stage is then impact is then also expected to be higher, because if you think that perhaps a building is burning and you can't get the fire brigade in, or there's a social disturbance that disrupts the social infrastructure, the loss in that environment might be higher. But I think in another area, you know, flood and drought has the same kind of thing, where the pervasiveness of the situation is a lot broader because of the lesser infrastructure around it. So that makes risk in Africa slightly tougher to take on, but I think it also creates the opportunity for like-minded areas or communities to look at more of a broad community mutualized form of risk solution which can exist.
Now, I know that your company has various areas of risk specialization, looking at sectors, and these are key core sectors which are seen as the ones that would really catalyze growth in Africa. It's the mining sector, construction, hospitality, telecoms, and even utilities. How do you go about ensuring some of those areas, or even just making risk assessments as to those who could insure those assets?
Well, the process is to analyze the clients in those industries, and in the mining context, one has even there a great variety of risks. We're lucky in this case that we've been spared the floods in the Eastern Australia, but we have our own issues in terms of earth tremors and so forth. And you know, even in the workplace injury environment, luckily there's been a huge improvement in fatalities underground and so forth. And so each of those issues would have a key effect on the risks. Mechanical risks can also have a huge effect in the mining industry. We run furnaces at well over 1,000 degrees. When a furnace goes, it's the whole furnace. So one's dealing with hundreds of millions of losses and so forth in each of those cases. So you look at each of those, the underlying risk. You need to assess the quality of the risk management, the quality of the assets involved, the quality of the risk management processes, and then the underwriters would look at it again in terms of impact and severity and say, okay, they believe this has a chance 1 in 10, 1 in 50, 1 in 100 of failing, and they'd rate the premium against the risk that way. What we do is obviously try and give the best balance of the market appetite for risk and the advice around that risk management so that those are aligned. And of course, there's value add perceived from the client as far as, and the insurers perceive.
How do you risk things which are intangible, whereas it's not sort of damage to property,
Sure.
but it's loss of property rights? I know that a lot of investors coming into Africa, that's their biggest issue, is breach of contract, property rights, in an environment where often the legal system is fluid.
Well, a proxy for that, starting with the basics of insurance, is political risk. And if a political risk underwriter was willing to insure an environment, that's a good start. Now, many developmental projects happen in Africa or in many ways, areas around the world, and these projects need 3 to 5 years to be fulfilled. And so if you're buying political risk cover, you'd be taking a 5-year view on X location. If an underwriter is willing to do that, at least you have a signal of a willingness to insure. The next issue is saying, you know, how do you get control over cash flows? Because you need to get your investment and your return back in a reasonable way. And if one can get some certainty around those cash flows through the billing systems, through protection, through security and others, one at least is a step forward. And so one goes through each of these steps, partially like a banker would, but also in the context of an operational model. And I think that's the benefit of insurance versus banking, where banking might say yes, no on the credit alone. Insurance says, okay, and how?
Yeah.
And how can we solve the issue? And there one looks at operating models, you know, interventions on cash flow, as well as pure business interruption. Your cash flow may be delayed for a while, but you might still get it later. A banker may struggle with that, but an insurer may say, okay, fine, I'll wait and I'll see what the proceeds of the project are later.